European wholesale gas prices have plummeted from highs of around 300 euros a megawatt hour last year to current near two-year lows of 25 euros. Is this a mere blip as Europe weans itself off Russian gas? Or could the demand destruction seen in the wake of the energy crisis have a more far-reaching and profound effect? How low can European wholesale gas prices drop over the coming months?
A lot of moving parts. There's Asian demand, there's high storages, underground storage in Europe, there's high LNG stocks, and of course we have a lower demand year on year. So how low can they fall? It will depend on a lot of these moving parts and on planned maintenance. Ultimately, though, it will depend on LNG. TTF will continue to be more or less linked to international LNG prices. For the first time in over 2 years, we have both European LNG prices and JKM, the Asian LNG price, below 10 MBTU. So it's the most bearish turn that the market has had in years, in a matter of months, as we've seen.
Ample supply, high storage levels and increased renewables output will continue to pressure prices in the months ahead.
Well, our own forecasts are that prices will be around current levels. We don't see actually that much of a drop further, but we say there are a lot of bearish risks on the market. Obviously, very high inventories are putting a lot of pressure on gas markets. We've got a very high filling rate at the moment, which could lead to quite a high level of storage already by the time we get to late summer. There are some support levels that kick in the 20s, but there are traders out there that are looking at potentially the shut-in price for US LNG, which would be more like 14 euros at the high end and 9 euros at the low end.
Has the up to 20% fall in industrial gas use in some EU member states been permanent or merely temporary?
Well, that's the big question in terms of looking, further forward. How much of the demand reduction that has been taking place so far is actually demand destruction? Long term in Europe, it's not good to have a gas-intensive process because of the emissions profile. So there's a push factor. There's lots of incentives to move gas-intensive projects over to the US, where there's lots of money being doled out as part of the Inflation Reduction Act. And I think what's been taking place over recent months is a lot of factory managers are waiting to see whether they're going to permanently shut down or not. The announced plans so far don't amount to very much, but some people in the market put the amount of permanent loss in the market about 15% of total industrial gas demand. We have a slightly lower towards 8 to 10% baked in from next year, but that's the question that is very difficult to answer.
And forward prices are currently not providing signals for industry to begin operating machinery they idled as the market soared.
And what I'm hearing from analysts is it's difficult for industries to commit themselves to restart their machines while they don't know how long low prices will last. And obviously, you're not going to restart a machine for 4 months.
The return or not of industry demands in Europe as well as in Northeast Asia will be the crucial factor in driving gas prices in the months and years ahead.